Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for September 12th, 2023. I'm Ken Adamo, Chief of Analytics over here at DAT. It must have slipped my mind because it's a Buckeye bonanza today. We're joined by Dean Croak, who's our principal industry analyst, but we also have Terry Esper and Jason Miller, both with strong Buckeye connections. Terry, you want to go first and maybe introduce yourself?
Sure. Hey, good morning, everyone. Terry Esper, the faculty here at The Ohio State University Fisher College of Business, professor of logistics. So good to be with you.
Thank you. Jason?
Yep. Hi, everybody. Jason Miller. I'm the interim chairperson for the Department of Supply Chain Management at Michigan State, and I'm the Eli Broad Endowed Professor of Supply Chain Management here as well.
Awesome. We're so thankful and grateful to have you both on. I had the great privilege of having Terry as an instructor during my time at Ohio State, professor, and Jason is the social freight savant, is I think what you should trademark, because you're always out there. Although I think I did chime in a little bit with FedEx's proprietary GRI pricing formula.
I got a kick out of that, man. Thank you for that. That's so true. I love the pseudocode, though. I mean, you just had to write it that way, didn't you?
Yeah. I mean, many, many years of sitting there going, I wonder what it's going to be. And then consequently, it's the same 10 years in a row. So we will come back and touch on that at the end, because there's actually a lot of intricacies around GRIs and things like that I think would be beneficial. But we're going to fly through our market update stuff since we have two esteemed guests this week. So I'm going to dive right into it and bring Terry and Jason back in a couple minutes. So key trends we're watching. So dry van spot rates are flat, maintaining prior week's gains in a short shipping week. The Logistics Managers Index, that's coming out of our friend Zach Rogers at Colorado State, rose to 51.2, the fastest rate of expansion since February. That's breaking an entire quarter of contraction. But the new orders are still in contraction territory. I think we can ask Jason about some of this at the end. Crude oil prices touched highest year-to-date prices last week. We're seeing supply tighten. Small carrier margins are being squeezed due to fuel. That's been a very interesting topic on LinkedIn the past couple of weeks. I've been doing the Fuel Chronicles, if you will, on my LinkedIn page with a lot of great discussion. The Detroit Big Three automakers labor agreement does expire midnight Thursday. And last but certainly not least, it is National Truck Driver Appreciation Week. A wave goes a long way. I've heard rumors that they love when kids do the little thing for them to honk their horns. So we do want to share in thanking and appreciating those that keep America rolling. So with that, I'm going to turn it over to our very own truck driver, Dean Croak, to get us through the market update. Dean?
Thank you, Ken. Yes, welcome to the show, everybody. Very quick market update this week. The long-form version of today's market update will be published this evening at dat.com/market update. Just download it all. The charts will be all there. So I'll quickly go through and give you some of the highlights. The load-to-truck ratio and dry van predictably down last week. It's always a short work week, so things do fall away. Load-to-truck ratio did move up slightly to 3.31. In the refrigerated category, California produce volumes really continue to put a drag on the entire market. The number of truckloads of produce coming out of the West Coast is about the same as what it was, maybe a little bit lower than 2016. It's about 7% lower than last year. It has a big impact on national reefer spot market volumes in general. So load-to-truck ratio lowest in 7 years, sitting at about 4.40. In flatbed, load posts continue to track around half of what they were a year ago, even though they were down last week marginally. Load-to-truck ratio up to 7.06. Highlights of some of our market conditions this week. Dry van capacity tightened slightly in our top 5 freight markets. Rates are up for the third week to an average of $1.70. Following last week's penny per mile gain. Remember, folks, these are line haul rates excluding the fuel surcharge. Having a look at some of our bigger markets on the West Coast in Ontario, rates were flat. Los Angeles rates were down for the fourth week in a row to $1.70. And after peaking at $3.40 a mile at the end of 2021, when imports from overseas were pouring into the US, line haul rates on the Los Angeles to Chicago lane have dropped $2.05 per mile, or about 60% since then, averaging just $1.35 a mile last week. In the refrigerated category, the USDA reported again for multiple weeks now a shortage of trucks for watermelons out of Eastern Virginia, Maryland, and Delaware. Volumes are up substantially there. That season continues to roll on. Outbound reefer rates in Maryland averaged $2.48 last week, up 23 cents a mile. On the busy Denton, Maryland to Atlanta lane, loads were paying carriers $2.14. That's the highest since February. On the West Coast in California's largest produce market in Fresno, rates dropped for the fourth week, down to $2.08. That's down 12 cents a mile in the last week. And in flatbed, capacity was tight across the Rocky Mountains region last week. Rates in Colorado, Nevada, and Utah jumped 35 cents a mile to an average of $2.11. Outbound loads in Nevada were paying carriers $2.70. Solid gains reported in Reno. Line haul rates averaged $2.37. And in the large Las Vegas flatbed market, spot rates averaged $2.67. That's up 14 cents a mile last week. Rates are starting to increase in Gary, Indiana. It's the largest steel production market for flatbed carriers. Rates up 5 cents a mile to $2.36. Having a look at our year-over-year look at spot rates, dry van spot rates were flat last week for the most part, going against typical post-Labor Day trends where they normally do decrease. They dropped 3 cents a mile this time last year. This time they stayed around $1.62 per mile. That's about 26 cents a mile lower than this time last year. In the refrigerated category, lower spot market volumes and loosening capacity erased all of the gains from the prior week. Last week, rates were down 2 cents a mile, averaging $1.98. It's about 24 cents a mile lower than this time last year. And lastly, in flatbed, following the surge in spot rates the week prior, last week, flatbed line haul rates lost some of their ground, decreasing by just over a cent per mile. They're sitting at about $1.93 per mile, excluding fuel. The national average last week was about 27 cents a mile lower than this time last year. And that's it for this week's market update. Remember, go to dat.com/market update. You can get all of the detailed information later this evening. Over to you, Ken, for the short terms.
All right. We have two sets of forecasts we're going to breeze through today. I'm going to talk through the short term first. So the blue line is the historical 7-day weighted moving average going back to April 1st. We've got four forecast models. The green, which is raycast, the red, which is a short-term model, and then a gray and a yellow, which are blends of the two. You can see a considerable amount of model disagreement here. The short-term model still continues to be very pessimistic. Our raycast model does show some strength heading into that first. So horrible reference, but peak for truckload freight typically looks like a dromedary camel. I think those are the ones with two humps, but either way, it's like this double peak where you get this kind of first rush and then it slows down a little bit, and then you get this second rush, which really culminates in leading up to Christmas. So that's kind of what the model's picking up here. So that'll be something interesting to observe. We have here the reefer forecast next. A lot of volatility here, but not much model disagreement, which I find to be very interesting. The three of the four models are in pretty much identical alignment with some choppiness. You have raycast with a little more strength near term, and then essentially coming back in line by the end of the 35-day forecast horizon. Flatbed, even more so. You're seeing all three of the raycast models having this shape where they expect the next maybe 15 to 20 days to be a little more bullish before it pulls back, but the other forecast models are not picking that up. I'm going to pivot now. We brought long-term forecast. You ask, we listen. People were asking about this last time. So this is our long-term forecast. We're going to do it for each of the three equipment types. So we start with dry van, just like we did for short term. This one's a little different. So we don't have the different forecast models. This is all coming out of raycast. So the blue dotted line is the base case, and then you have a bull and a bear case, the bear case being red, the bull case being green dotted lines. So you can see here, this model has aired more and more and more pessimistic, I would say, over the past couple of months about recovery. It is still showing rates to bounce back heading into the spring of next year, but then the baseline model is showing some softness on the other side of that. This is, I think, where you should really be blending your technical analysis with your kind of internal learned and lived experience, because I think this model is not going to pick up some of the macroeconomic variables that could steer things back into recovery, or I think in the case of the bear case, worsen it. Let's get to reefer real quick. Much more agreement heading into the end of the year and the start of next, and not as much pessimism coming in on that bear case, the red dotted line. I think that would be very, very, very pessimistic, dropping total national rates below where they dipped in the COVID lockdown. But again, we're reporting here exactly as the model spits it out. Let's last go to flatbed, which is kind of hilarious. So what we see here is rates coming down, getting floored a bit for roughly 40 of the 52 weeks on the bear case. The bull case has it shooting right back up. into almost instantaneous recovery. But this is an example of where I think Ratecast's base case model is pretty much tracking to where we believe things to go over the next 52 weeks. All three of these are available. We will send them out to you if you email us at askiq@dat.com or drop us a note on LinkedIn, whether it's Dean or I. More than happy to share these. We update them about once a month. And again, they're available in all of our products if you are a customer. So with that, our speed run through our market update this morning, I think it was a record 11 minutes. We're going to bring everyone back and ask the most important question of the week of the entire year on this program.
Yeah, thank you, Ken. So the question of the week is, will Ohio State beat that team up north this season?
Who put that there?
Oh man, talk of the town in my area for sure, right?
I mean, it's the most important thing.
Yeah, that's all that matters, right? It literally is all that matters. You know, it's interesting. It's actually good to have the series be competitive. You know, to be honest, I mean, there was some years there where it was just a given that Ohio State was going to win that game, and so the last couple of years, of course, OSU has struggled. In fact, 2 years ago, when Michigan beat Ohio State the first time, that was at Michigan. You know, it was snowing. I'm born and raised in Michigan, so I'm living both worlds. And I knew then, I said, yeah, it was a snowy day. And it just had that brisk Michigan football appeal. And I said, yep, I think OSU is going down today. And so nonetheless, we'll see where we land this year. But I do believe that it's just a good run. It's good to be back into a competitive space when it comes to the rivalry. And we'll see how the year shapes up. But as far as I'm concerned, go Bucks.
Go Bucks. Jason, I feel like I could let you abstain from this question because you're kind of too close to the.
Yeah. I mean, well, Michigan. I mean, I'm in Michigan State. We hate Michigan probably more than Ohio State hates Michigan. So I mean I think that's what a lot of folks in Ohio don't realize is for us that's our biggest rival too. And I think that stems. We're the land grant. We're the larger institution. You know, U of M jokes that they're the Harvard of the Midwest, which is comical. Yeah. My wife went to Harvard, and her statement is, if you have to call yourself the Harvard of something, you're not Harvard, so can it?
Miami of Ohio, hello. They're the Harvard of the Midwest.
Yeah, again, I've got great friends there, and I will say the same thing.
Same here.
There's one Harvard, and it's in Massachusetts.
Oh, man. Yeah, I'll tell you. Hey, no, go ahead, Ken. Go ahead. No, go ahead.
I was going to say, so pivoting a little bit, I think most people tuning in, they'd be tuning in to other outlets if they wanted football talk. I think the real question I wanted to ask both of you, maybe start with Terry, is we've sort of transitioned to the more permanence of this new normal, right? We've seen both the ups and the downs since COVID. And we all, most folks in the industry expect in the next couple of quarters, we'll go back into the next full freight cycle across the board. How do you think we'll emerge into that cycle? And what do you think will be permanent coming out of COVID?
Yeah, that's a good question, and the way I've been looking at, this whole notion of the new normal and where things are going to land, I've actually been looking at that through the lens of kind of what's happening in the market as a whole, particularly looking at what's going on globally, right? And we're seeing so many global shifts, and that, of course, dictates how everything is managed in terms of the network across supply chains. So, of course, we're seeing so many global shifts and so many risk reduction initiatives being put in place. Again, companies moving things all around the globe in order to try to reduce the risk of managing their respective supply chains. And then at the same time, I've been looking at these issues through the lens of the ultimate consumer in the market to kind of get a feel for how we as everyday shoppers and consumers in the market might actually impact what happens in terms of freight moves. And, again, it's interesting, we're going back to stores more than ever before. And in fact, there's been some really good research that has looked at the whole psychology of COVID and the notion that we're kind of trying to forget it. So I think we're going back to what will be relatively a normal state. And I think it's going to mean that, in terms of, freight and in terms of overall, kind of movements along supply chains, I think we'll go back to those pre-COVID numbers. Again, I think there will be some tapering effect of, some of the online retail hype that happened over the last 3 to 4 years. And that's going to pull us back to, I believe, some normalcy, which will then, pull us back to maybe larger freight moves, et cetera, associated with getting product through the supply chain. So that's just just a couple thoughts as we kind of open the conversation now.
Jason, what do you think?
Yeah, so I mean, right now, coming out of this cycle, I expect it to be a very muted. Next time we start to enter bull market territory, it's not going to feel like 17 or 18, where we had this big shock of demand due to business investment, hurricane recovery efforts, and a big commodity market boom. I think everybody forgets the second fracking boom that took place in 17 into 18. That's not happening again. So I think how we exit this will be quite muted. And this is more on the truckload side. On the LTL side, the bear market ended with Yellow's failure. We can see year over year volumes are up at all the major players. We're just waiting that August PPI data to see where pricing, has moved to. So, but, coming out, this is, I think, going to be very gradual. I think the soonest we start to functionally come out of the recession in terms of freight volume is the second quarter of 2024. And that is the best case scenario. I think the worst case scenario is we're looking at 2025. And when you go back historically, it was common for 2-3 year freight recessions in the late 80s into the 90s, into 2000 to about 2003, 2004. As Terry mentioned, we're seeing, e-commerce activities regressing back to the pre-COVID trend line. There was so much thought when COVID hit, we'd have this huge step function jump and then just continue our linear trajectory. That did not come to pass. That's why, Amazon added too much capacity and is now leasing it out and having to draw it down. We have not seen capacity exit the trucking market as quick as folks have thought. I remember last year at this time, you had all the big TL carriers saying, "Oh, a ton of capacity is going to leave by the first half of 23, and that'll start shifting the market." That has not happened. Yes, capacity is leaving, but much more slowly. I think we're in for an extended period right now of blah. I mean, we are seeing certain sectors where things are now up year over year. The American Iron and Steel Institute has steel production for the last week 2% higher than the same week for 2022. So it's not like we're seeing massive decreases everywhere. But as was mentioned, the importing side has really calmed down from this time last year. And again, it's back to the pre-COVID trend line.
Mm-hmm, mm-hmm.
Well, so that kind of, Dean, I forgot to, what's your perspective? What do you think is one of the biggest things to change coming out of this full cycle?
I think Jason touched on it, and that's the exodus of capacity, right? It has been relatively slow, but diesel was up another 5 cents a gallon yesterday. So that's up around 77 cents a gallon since July 4. So that's bumped up operating costs by about 8 cents per mile. If you work on the basis that for every 10 cents a gallon, it increases operating costs a cent per mile. We haven't seen the full effect of that squeeze just yet. We've started to see an increase in carrier exits in August. I think that'll accelerate now, just like it did last year, following the peak of $5.81 a gallon in the summer. So I think Jason's point is accurate. We've been losing capacity at a slow rate, but mostly because diesel was dropping fairly gradually up until the Independence Day break. I think we're about to see an acceleration of capacity out, which could change the dynamics. That's the sort of the wild card I'm watching is diesel prices.
Love that. All right, I'm going to pivot a little bit because I want to postulate a little bit and not just rearward look. So the last two big booms, I mean, I think we could talk about, certainly COVID was a black swan, right? We can all agree that no one saw that coming. And then before that, I mean, the intersection of tropical weather, the energy boom, and ELDs, any one of those could have been predicted or observed, but I think the culmination of all three is what drove the market into a frenzy. So I'm not asking what will, but what's one thing, maybe I'll start with Jason this time, one thing that could kind of catalyze another bull run that we saw the last two cycles?
If the Fed starts lowering interest rates, let's say early in 24, let's say February or March, they decide to start lowering them, single family housing. That would be the one thing. We have a tremendous amount of home buyers waiting in the wings for interest rates to come down on mortgages. And so if we start seeing the FOMC reducing interest rates, that would be the biggest catalyst. Right now, you know, there's a lot of global uncertainty at the moment. I mean, China is a good case in point, but we just don't export that much to China. I think I'll put the statistic out sometime in a week or now. But like 1.4% of U.S. domestic manufacturing gets exported to China on a dollar basis. So it's fairly low. But I think single family housing and interest rates hold the key right now. That's the only real thing, though, that's going to shock it. I will say, again, there's so much talk about reshoring. A tremendous amount of that's going to Mexico, so it's going to show up as cross-border trade. You've got C.H. Robinson announcing that massive cross-dock down by Laredo. But just to be very clear, manufacturing output in this country is down 2% from where it was this time last year. And if we may be in about 3 days starting to see the largest auto strike, and Lord knows how long, that could take about 20 to 30% of industrial production for motor vehicles and parts out of the equation here very, very quickly.
Terry?
Yeah, no, I think I'm going to pick up right where Jason left off. I think, you know, again, I typically look at these things from, you know, more of a broader perspective. And I don't nearly claim to be as analytical as my buddy Jason here. He's the savant. But, you know, when we talk about labor, I mean, we've had some really significant labor discussions, be it the UPS conversations. Now we're talking about the automotive manufacturing space. I think, you know, just one of those real big trends that I've been really looking at is just what's happening in the labor market and how labor conversations have really started to bubble up just more significantly. And I think it's going to be something really significant for us to watch and to just to be mindful that, you know, again, I think what we saw, I mean, you talked earlier about how it's, you know, truck driver appreciation, you know, and the notion of truck driver appreciation. I think we're just seeing so much more focus on, you know, the work of moving product to the marketplace. And this is becoming something that people are talking about at dinner tables, right? I mean, never before had I had so many inquiries into, you know, what's happening in supply chains and how the UPS conversations and even how the automotive conversations will impact how product gets to the market. And this is from average people in my family that are having these discussions. And so I think, you know, the labor issue is definitely one that I think we need to keep our eye on. And, you know, Jason, you also mentioned, you know, just kind of global dynamics and nearshoring and reshoring and all of those conversations. Again, I think we continue to watch that. I just had an opportunity to keynote an event in the Dominican Republic. And again, the conversation was around, you know, where are things going globally and how will that affect, you know, things like, you know, freight and freight movements and distribution around the globe. The last thing I'll just mention again in terms of those macro trends is, you know, weather and climate, right? I mean, we just cannot, you know, turn our eye away from what's happening in terms of this extreme weather and how it will affect how product moves. So just a couple of macro trends that I would throw into the mix there.
Dean?
Yeah, I think great points, Terry and Jason. And the other wild card I would see, Ken, is the hurricane season. I don't know that we've seen the full effects of this yet. My informal internal prediction was fewer events, but much more severe this year. And I think our whole, you know, that gasoline alley, chemical, you know, gasoline production area along the Gulf Coast is incredibly vulnerable to an intense hurricane over those boiling hot waters. I don't think we've seen the worst of it yet. I hope not. But that's my biggest fear, is that this year you've got the perfect storm of ingredients for hurricanes to intensify up through the Gulf if we're unfortunate enough to get one. That could be market.
Yeah. I mean, freight markets love to be disrupted by weather, right? I mean, even like the mini disruption, right? The market was honestly headed back for contraction in February of 21, and then the polar vortex hit and Omicron hit, and then it shot it right back up. So, and I think even back to like Superstorm Sandy had a huge impact on the freight markets, if we remember that. Or, I mean, I was still at the utility when this happened, but like the first polar vortex, right? But whenever we coined the term, it was like, holy cow.
2014, yep.
Yeah. So, you know, those are all really, I think, impactful points. And I have one that neither of you mentioned, and I'm curious because we had a couple questions on it in the comments that I'll bring up now, is freight in an election year is always a really hot topic. So maybe I'll start with Terry there and go, you know, next year we're all kind of talking about recovery, but it's a presidential election year. What's your thoughts there?
Oh man, you know, we could go on and on about that. You know, again, from a, you know, kind of going broad stroke here, and I know Jason will kind of probably have some good data to back this up, but it's just very interesting how, you know, when we really look at how politicized, if that's the word, politicalized or politicized, probably one of the two. I didn't go to Harvard, Jason, so you have to ask Paula what's the right way to say that. But, you know, I mean, the reality is that, I mean, supply chains have become so political, right? And so we do know that what happens what happens in DC has a significant impact on what happens in terms of how freight is distributed. You know, we get a Washington update every so many months at a conference I attend, and it's very interesting how, you know, this has always been one of the areas where we would think that there would be some bipartisanship, and again, we just see that all the way down to, you know, how product is moved, and all the way down to infrastructure development, that, you know, we still see where things get locked up. So again, in anticipation of the uncertainty of what could happen politically, right, we start to see companies ramping up inventories and starting to think about how to effectively navigate through the impacts of an election. And so I think it's a great point to call out, Ken, is that we are upcoming, and an election is upcoming, and it's going to be a very contentious election based on what we already see. And so it's going to be one of those that we, of course, will definitely be keeping our eyes on. And it's going to be interesting to see how it all plays out.
Jason?
Yeah, so I think we give, in terms of the overall macro dynamics, we give what party's in power way too much credit. I mean, if you go back to, say, the last 50 years of trucking, what was the best time period? It was by far President Clinton's presidency. Freight volumes grew 30% from 1993 through 2000. We've never had a period sustained like that. You know, I'd say, I think there's a bias to believing that, you know, Republicans are more business friendly and therefore that's good for freight. But we, you know, saw manufacturing activity decrease during the Trump presidency in this country because of tariffs. When you've got one party saying we're going to put a 10% tariff on immediately, that will cause a massive manufacturing recession. I mean, maybe there'll be a little bit of a bump as everybody rushes imports over a la back half of 2018. But then once those imports are here and that inventory is here, freight volumes decline just like they did in 2019. I personally don't think either party has a great grasp of economics. So I really don't think it will matter this time, because one group may be less open to oil drilling and, let's say, chemical production and things like that, more regulation, but the other group wants to throw tariffs on everything. And so it's a wash. Bluntly, both groups don't know really what they're talking about.
There's a phrase I won't repeat on this family-friendly podcast about the difference between both parties. But Dean, any thoughts?
Yeah, I think AI and disinformation is going to be a really big problem for drivers this year. They have too much windscreen time as it is. When you start to get drivers thinking about things that aren't real, I think that takes their eye off the ball. It distracts them. You've got a safety risk, but I think you've got a mental health risk. So I see that as being a big challenge for drivers. You won't see it in the economics of trucking, I don't think. You may see it in driver turnover numbers, but I'm more fearful about what drivers think about the industry, because I think their perception is going to be skewed by some crazy talk out there. It's already starting to manifest itself.
For sure. Yeah. And Terry, I know you have a hard stop, right, coming up in 1 minute. I just wanted to say thank you very much for joining. You're actively involved with the CSCMP, correct? Can you just maybe give folks a rundown of how they can get in touch with you, either at Ohio State or through any of your other dealings?
Sure, absolutely. Thank you. Thank you so much, Ken. And yeah, I do have a hard stop, unfortunately. So I am not only the professor of logistics at Ohio State. You can reach me through OSU Fisher's website, but I'm also the incoming and will be board chair of the Council of Supply Chain Management Professionals. I'm really excited to serve in that capacity. And we're really excited about all the work that we're doing around our Transportation Center of Excellence. And, you know, you referenced the LMI that's being done by our friends and distributed through CSCMP. So just really excited about that opportunity and to be able to serve as chair of a fantastic organization. And, of course, to wave the Ohio State University's flag in the process of doing all that, right, which is back to our conversation at the top of this, right? So, hey, I thank you for the opportunity to engage and to connect and to be a part of the conversation.
Thanks, Terry.
All right. Thanks, Terry.
Thank you.
All right. Thanks, guys.
So there was a couple other questions that we can maybe get to. Ben, help me out. I've lost them. We've covered elections.
You can cover anything else. I intentionally block my calendar for like another hour. I just don't tell people that. So I just
We go that long.
Did say
this
so
one.
if anybody from this college is watching, you didn't hear that.
So we kind of covered it indirectly, but I wanted to hone in because we all mentioned it, and then Scott in the comments asked the question specifically about how a UAW strike would kind of more specifically impact freight. And I think being in the heart of freight, big three freight country, Jason, maybe you're best equipped to answer this one.
Yeah. So I mean, I'm going to go back and basically say, okay, what do we know historically from the GM strike of 2019? Because that's the exact same starting point, literally same day, and let's assume 6 weeks, and that was 48,000 folks. We saw motor vehicle and parts production decline 5.5% that September from August, and then 11% in October from August. So it basically doubled, which makes sense because it's half a month to a full month. In terms of freight activity, the 10-mile index I co-produced with Yemboy Mole, we picked up about a half a percent seasonally adjusted decline in September from August. That accelerated to about 1.1% in October from August. So you start multiplying this out and say that's 48,000 folks back then. We're looking at about 150,000 this time if it's a strike on all three. So let's assume worst case scenario, strike all big three. Multiply it by 3, that means that we see about 15% decline in motor vehicle and parts production this month, 30% decline in October. 30% drop is the equivalent of when we shut down motor vehicle production in March of 2020 in the back half. So that was really like the last week. So that means for our 10-mile index, we're looking at a 1.5% drop this month and a 3% drop in October. A 3% seasonally adjusted drop in 10 miles in 1 month is equivalent to the February 2021 polar vortex in terms of disruption. So we are going, if we have a 6-week strike, we are looking at a freight recession that we felt like we were in a trough and we're about to go substantially lower. It will basically double the magnitude of this freight recession, albeit for a short period. And it will cascade over certainly beyond motor vehicles and parts. It's going to hit plastics because all the plastics that go into vehicles. It's going to hit the steel manufacturers. Cleveland-Cliffs is especially exposed as the largest supplier to the auto sector. That's going to cascade upstream to chemical production because you're going to need less plastic resins. You're going to need less paints, which means less basic chemicals. Bluntly, it's a mess. Motor vehicles are one of the most freight intensive, industries that there is. And it will be very, very, very rough on Michigan, Ohio, Illinois, Wisconsin, Pennsylvania, because this is still kind of the heart of Big Three Auto Alley up here. So if we see a prolonged strike on all three, this is a very significant event for the freight markets. And I still don't believe there's any type of recovery, even without a strike happening this year, but it will 100% eliminate any chance of there being some type of freight recovery if this happens.
Wow.
Wait, say that last part again.
Yeah, no, this will completely eliminate any chance of there being any recovery as we move into Q4 of this year if we have a prolonged auto strike. I mean, again, I don't see any type of Q4 recovery and freight activity that's not beyond just traditional seasonality. But I mean, this will wipe that out.
Well, that's not good. I mean, I think the only thing we can hang our hats on a little bit here is the last every strike, except for a little kerfuffle in Southwest Canada, resulted in a deal.
I don't feel as good about this one because the UAW definitely has a history of striking, and both sides are
I don't either.
They're so far off in terms of where labor is. And the other thing, and I'll have to throw this up on LinkedIn at some point, but if you take the average hourly wages at the automakers themselves for the United States and you just adjust it for inflation, back in the late 90s, early 2000s, that was over $40 an hour average inflation adjusted wages in 2022 dollars. That number today is about 27. So you're looking at a sector that over the last 25 years has seen a massive decrease in real wages. And given you've had such profitability for the automakers the last few years, despite all of the disruptions, I don't see the union being very negotiable on this. I mean, look at the deal UPS gave their workers. I don't know if the big three are going to be willing to give that type of deal.
Wow.
All right. Well, on that note, I think we're out of questions and we're running up on out of time. Any plugs to share?
A couple of quick plugs. We're on Sirius XM this week, Landline Now tomorrow evening, 7 p.m. I'm on with Jimmy Mack Thursday morning, current Freightvine podcast. Chris Kaplis is talking to Jennifer Carpenter, CEO and President of America Waterways. Fascinating if you're interested in the barge industry. We've got DATCon coming up on October 10 to 12 in Houston. On next week's show, we've got Dustin Jalbert from Fast Markets talking about lumber and housing. Back to you, Ken, to wrap up the show.
So I want to thank Dr. Jason Miller for joining us. As I said, he's a friend of the show and a endless font of information. I highly suggest you follow him on LinkedIn and keep up with what he's talking about. We didn't get to the GRI conversation, so maybe that's the next time we have you on. We could really get into that. Having spent many, many years of my life working on in and around GRIs and kind of the intricacies, I think that'd be a good topic for a future program. I also want to thank Terry again, Dr. Terry Esper, for joining us. We will be back next week, right, Dean? Yeah, there's nothing going on next week. We'll be back next week, as Dean mentioned, at 10 a.m. Eastern. Again, when you're out there, a wave goes a long way. Give them the heck. If you're in a travel stop and you see someone, sitting down to a breakfast or a lunch or a dinner, maybe foot the bill. That's something that goes a long way. A little bit of money can go a long way in showing appreciation. So we thank our truck drivers out there and hope they stay safe and have a great week and feel appreciated. Bye, everyone.
Thank you.
Through the course of these next 2 days, there's no better chance for us to get your input and answer your questions in one really great collaborative event.
We have so much innovation going on and so much investment, so I can't wait to share this. This is exciting. We're using AI and machine learning and intelligence so you get action right away.
It's about bringing together all aspects of the network to solve your problems.
And we know that you all move faster if you provide that connected experiences for you.
We are trying to make it easier for you to use our products. It's going to continue in 23, and this is a testament to that. With 2 million trucks in our app, all of this stuff in the network, all of the knowledge in this room, we can legitimately change this industry.